Okay. Good afternoon, everyone. It's 13:01, and thank you very much for joining us this afternoon. This is the very first of our sessions for 2026, where we are looking at tax year-end tax planning. And some would have looked at this in February, but we just want to be proactive and see if we cannot assist some of our clients or prospective clients or anyone who needs the services or understanding of tax prepare for year end. We usually get a few inquiries from people in terms of what do I do now? Tax is it can be a bit problematic for some people, especially if you don't understand. And the other thing is because of the changes in legislation from time to time, the tax practices end up changing. And I think that's what frustrates a lot of people because they don't understand why are there such things happening between them and SARS. So this is our very first session on for the series on Wealth Builder series. And if you follow us quite carefully, you will notice that we actually have related webinars. Some months we'll talk about retirement, some months we'll talk about taxes. So just be on the lookout for our posters in terms of the webinars that we are running, as well as check our social media pages, our YouTube page, our Instagram, so our TikTok page. So we also have some nuggets that we just publish on a weekly basis, just to remind people of some of the important things that you need to be careful of regarding your finances. So again, thank you very much for joining us. And if you have missed this session, you can go to our social media pages. So my name is Ntabiseng Mayidi. I'm a chartered accountant and a LLB holder. I've got a few executive development programs, and I'm the CEO of MMCP Advisors, where we look at simplified, streamlined, and integrated financial solutions. We don't look at financial services in isolation. So you'll notice that our services are very integrated because we believe that our clients need to get a consolidated or a holistic integrated financial solution. So today's session, I have spoken about it. We just want to look at the most important aspects to consider before the end of the year in preparation for year end. And let us not confuse the assessment period, which starts in July for individuals. Let's not confuse that to the tax year end. I'm going to give you the dates in terms of how the tax program works. So today we just want to make sure that you understand your deductible expenses. How are you going to avoid penalties and miss any deductions, and ensure that you are ready to submit your ITR 12. So the other thing is that some people are actually losing a lot of tax savings because they did not prepare on time. You cannot incur, for an example, you cannot incur an expense in March and hope that you will deduct that for the February or the previous year financial period. So hence it is quite important or critical that you prepare before the 28th of February. These are the tax year dates. The tax financial year starts from the 1st of March to the 28th of February. So this applies to a majority of companies. It applies to all individuals. And you will not also notice that for government institutions is different, and for other companies is different. Some run from July to June. Some run from Jan to December. So there are different tax dates for companies. But in terms of individuals, all individuals are on 1 March to 28th or 29th February. And then there is the July period. During July, that's when the auto assessments or individuals are expected to do their tax submissions. So by that time, you should have prepared your file in terms of all your deductible expenses and all your records. Then we've got provisional taxpayers. Provisional taxpayers is anyone who gets more than one income, not only employment income. Let's say you have got rental income, you are doing farming operations as a sole trader as well. You have got other income other than your employment income. You will be considered a provisional taxpayer. Or you are someone who doesn't have full-time employment, however, you are getting income on a regular basis. So you've got intermittent income. So you are a provisional taxpayer. You are a contractor. You have to be a provisional taxpayer because you don't have set income. Then the other important thing that we need to take note of is you need to keep your records for 5 years. SARS can come back and request you to provide the evidence of your tax deductions or submissions for the last 5 years. So these are the critical things that you need to, or dates and information that you need to be aware of for SARS. So let's look at what SARS look at. So one thing that you need to be aware of is that SARS now looks at third-party data. I think late November, early December or October, there were talks that now SARS has got agreements with banks so where they can access your information and from the banks. So this data sharing agreements and digital reporting is now legislation in terms of the Income Tax Administration Act. It is now a requirement that there should be data shared between institutions, and SARS has got that unprecedented visibility into your bank account activity. So, and this applies to businesses as well as personal finances. And where there is inconsistencies between what you have declared and what goes through in your bank, SARS will end up actually doing an audit. Some of you might have actually also received a direct debit from SARS if you were owing them any money, especially from your business, or the debt is too much and you haven't been paying, and they can see that there's some activity in your business. So they might end up taking money from your bank account. You might have 4 bank accounts. Believe you me, SARS has got access to all of those bank accounts because of the third-party data agreements. The other thing is that for all income earners, you need to be able to declare your income from your salary, from your business, rental, investments, and so be it. And some of the documents that SARS will require will be your IRP5s, IT3s, medical schemes, RAs, and bank information. Those that are doing their own tax submissions, you will notice that when you do your assessment, SARS would have already obtained some of your information in terms of the IRP5s, IT3s, and the medical, the IT statements from medical schemes and retirement annuity providers. So that's where the data sharing comes in. And the other thing that SARS looks at is to look at consistency with prior years. So you need to explain if there was a change in prior year income. And if you are the unfortunate one where SARS requires that you provide supporting documents, you will have to provide the supporting documents for your deductions. So let's look at what you need to prepare for in terms of your employment income. So just always make sure that before the end of the year or just after the end of the year, employers prepare the IRP5s from March. I think it's between the March and April period where they submit the IRP5s. Please make sure that the IRP5 that you get corresponds with your 12 months or your monthly pay slips. Because sometimes I've seen situations where there were changes on your pay slip. Unfortunately, when they look at the IRP5, there were some inconsistencies. So just do that reconciliation of your IRP5s or your IT3A in conjunction with your monthly pay slips. The other thing is your travel allowance. You should not be having when you have travel allowance. It is important that you keep record of your expenses for travel or you utilize a logbook. So in the next two slides, I'm going to talk about travel allowance. Where you have got fringe benefits, be aware that those fringe benefits are part of your employment income. Let's take an example where someone is using a company car to travel. Your employer is supposed to include the use of an employer-provided car as part of your total income because SARS deems that as income on your side if you are using a company car. If you are using a company cell phone, so it's going to be deemed as a fringe benefit. Understand what are the free things that you are getting from your employer that SARS deems as a fringe benefit. The next thing that you need to make sure that you keep in place is your company car details. I've already spoken about that you have to declare that as a use of company car. Where you are receiving foreign employment income, you need to have record of that. I don't know for those that have submitted their own income tax return, you will notice that there are so many areas where you need to declare the type of income that you are getting as employment income. One example, you have got an online course that you have registered or you are providing online courses for people outside of South Africa, or you are a teacher, online teacher, and you get money from a foreign company. Unfortunately, in terms of the Tax Administration Act and the Income Tax Act, when SARS determines as to the basis of your taxation, we use a residence-based tax system, meaning that if you are a South African resident, any income that you get, provided there is no double taxation agreement with that country, any income that you get whilst you are a resident is going to be considered your income in South Africa, and you need to declare that. So be careful of those foreign employment income, those side hustles that you do where you're getting income from time to time. You need to declare that as foreign income. If you are doing drop shipping and all of that, and you are doing that as a side hustle, not as a registered separate entity, you need to declare that. Let's go into some of the biggest tax levers that you need to be aware of. The first one is retirement contributions. This includes your pension, provident, and your retirement annuity contributions. I really like this, especially especially for business owners, especially for independent contractors who are sometimes getting huge payments or huge receipts, and their tax end up being about 45%. And by the time they don't even have retirement plan, so you can use that as part of retirement planning. So the important thing is that when you have got any of the three, your deduction is kept at 27.5% or a maximum of 350,000 per annum. This comes as a deduction. This is quite huge. You can do your own calculations in terms of how much that is if you were to maximize on the 350,000 per annum. And ensure that if you are doing those contributions, your pension fund holder or your other asset manager are going to provide you with a tax certificate at the end of the year, because SARS will need that for them to allow you the deduction. The other thing is that this can also work as a cash flow mechanism. There's a lot of people who will say, oh, I got a tax deduction. I got a tax deduction from SARS, a tax refund from SARS. This is one of the things that actually contributes to other people getting refunds from SARS, because they would have used the retirement annuity, additional retirement annuity contributions to maximize on their tax. The other thing let's say you have already exhausted your 350 contribution in a month. That 350 is about 29,000. Let's say you have exhausted the 350 in a year. SARS is going to allow you that the excess contributions be carried forward in the next year. Then we will deal with the issue when you reach 65 and we have got those excess contributions. Then we can actually see how that we've got a different way of dealing with that, but SARS continues to allow you to have those contributions. The most important thing here is if you have not maximized on your retirement contributions and you have got free money sitting at a bank, earning 2% interest per annum or 4% interest per annum, make use of this and take some of the funds, deposit them into your retirement annuity plan before the 28th of February, as that is going to reduce your annual tax. At some point, you might end up getting a tax refund from SARS. Make sure that you do that before the 28th. Most companies that are managing pension funds or retirement annuities will have a cutoff date of between the 15th and the 21st of February. Some of the companies that we work with, they'll have a cutoff date of about the 25th of February. But make use of this. This is one of the biggest nuggets that I can give you in this webinar. The next one is your medical deductions credits. So these are medical scheme tax credits that each and every person gets, provided you have got a medical aid. And all of this are automatic for individuals. And there are different amounts for the main member as well as the dependents. So there's different amounts. You can get quite a sizable amount from this medical tax credits. So what this does is that it reduces the tax that you are going to pay if you have got any dependents. Then be on the lookout again for out-of-pocket expenses. There's a lot of guys, I'm one of them, where I prefer not to have a very expensive medical aid because I don't get sick as often. But what I do is all other medical expenses, we make sure that we keep the receipts for that. If I'm visiting a doctor and like my medical plan doesn't allow for visits, so I just pay that out of pocket. I save, I put away the receipts, and sometimes some medical aids can actually give you a list of those expenses that they did not pay for you. But what I've seen recently with SARS is that you can have that the list from the medical aid, but SARS is going to require a proof of payment and an invoice for it. So make sure that you keep all of those medical expenses and the proof of payment so that you can claim. The other big one is disability expenses. I know that in some townships that you have got people who have got children with disabilities, and there's a big list of what is considered a disability for a person. If you have got a disability expenses, I've got a friend who got stroke at some point and she couldn't work. And she went to the doctor, and the doctor gave her a certificate, and she managed to deduct all the expenses that she incurred. Remember, your medical aid will be exhausted at some point, and you will end up having to pay some of those expenses on your own. As long as your doctor has actually indicated that those qualify as disability expenses, you will be in a position to deduct that. For parents who've got children that are over 18 years old but are still students until a certain age, around 26, and they are dependent on you. The important word is, are they still dependent on you? Even though they are older and you are paying for their medical expenses, you can be in a position to deduct those expenses. Remember, you need to have proof of those. And I must say that there are different rules for anyone who's under 85, 65, and those that are over 65. This medical expenses as well is one of those areas. Travel and vehicle deductions. So this one refers to when you are receiving a travel allowance. If let's say you are earning a commission at work, so you can utilize that and make sure that you have got a portion of it allocated to travel allowance. The most important thing here, and this is what makes a lot of people end up paying back some money to SARS. I know this from experience, people where they could not deduct expenses from SARS. And that's because they did not keep a logbook. The important thing is that the fuel, maintenance, and insurance for the car is fully deductible. So what you can do is that you can either opt for either of the two methods if you want a deduction. You either keep full receipts, or like if you put in petrol for work-related expenses, you must keep a record of that. If you're doing maintenance, you keep a record. Insurance, if you put all of those expenses, you add them up and you can show us that you are incurring all of that for the car, for work, they are going to allow you a deduction. Alternatively, there is a formula that SARS will work on, whereby you have to identify what qualifies as business travel and what qualifies as private travel. And you actually have to do a proportionate. We've got limited kilometers in a year, and you have to proportionate that between business or private if you did not have or maintain a full record of your business travel. One issue that you need to be aware of: traveling from your home to your office is not considered business travel. You are going to work. Business travel is when you leave your work, use your car to go and see your client or go to some meetings. So that is what you have to consider. So, and here I've spoken about earlier, there is a difference between an employer-provided vehicle for business as well as for private use. If you are using that employer-provided vehicle only for business, that is a business expense. It's not a fringe benefit. A fringe benefit is when the employer provides you that car and you use it for your own benefit. Weekends you travel with it and that. So that is where the fringe benefit comes in. So be aware, I've spoken about it. No logbook, no deduction. Remember the 28th of February. We are going to issue a list before the 28th of February, or on the 28th of February in the morning, we'll just do a checklist that what are the important things that you should have achieved on the 28th of February. Remember to record the closing balance of your kilometers on your car. If you are using one car, well and good. If you are using two cars, please make sure that you do that for both cars. One of the advantages of having a tracker in your car, some tracking companies allows you to have a logbook, and that logbook, and some will actually write that their logbooks are acceptable by SARS. So you just make sure that you use that. Let's talk about home office deductions. This could be an advantage or a disadvantage, but another thing is, let me indicate that it requires us to scrutinize your information a lot. At some point, I know that I did claim for it, and they wanted to see my house plan. I literally had to go and get my house plan, go with that, and show them where the area is. And we had to calculate the square meters that I was using in the house. And I was in a position to do that because I had evidence of my office at home, that I was using a specific room as my home office. Now that a lot of people are working from home, I just ask myself, how many of us are actually using the home office deduction as an expense? So if it happens that you buy a laptop to use at home, you buy a what is this? An inverter to use for your meetings and that, because sometimes there's no electricity, and so you must include all of those: the rent, bond interest, the utilities, but you need to be in a position to apportion that based on your square root of your home. So, but this again requires you to have evidence for all those expenses. Earlier on, I was talking to the ladies at the office, and I was like, some of the people that I know, especially the rich ones that are tech savvy, they've got offices in their homes. And you ask yourself, these people have been clever all along, that they make sure that they've got an office in their home because they know that they are going to deduct that as an expenses. Because you are an executive, you have to read in the evening, you have to do this and this, and you are required to work from home at some point, you can claim that as a tax deduction. Let's talk about those that have got rental income and expenses. Let's say you have got a few houses, Kokasi, or that you are renting out, you are getting 700 there, 600 there, and all of that. Unfortunately, if you are getting that through your bank, I'm not saying that you must go and get it in cash. Obviously, SARS will catch you at some point. But you must declare all of that rental income. So what SARS allows you to have is that, let's say you have got 4 rental houses. SARS is going to allocate a unique identifier for each of the different additional incomes that you are getting, including the rental income. So what you can do is you need to make sure that you can deduct the interest on the bond if you've got a bond for that house, the levies, the insurance, the admin cost, the repairs, cost of an accountant to prepare the profit and loss statement for you. If there is wear and tear allowance, you include that. And if you've got a lease agreement, you need to actually make sure that you keep the lease agreement, you do invoices for your tenants on a monthly basis, and you submit that to SARS. And SARS will ask you whether you want to ring fence that or you want it to include that as part of your total income. You can decide what to do. The big one again is, which is contagious. I know since they've spoken about this thing that's in the media, talking about in community of property marriages and all of that. If you are married in community of property and you and your partner, or you guys have got properties that you are renting out, unfortunately, the income or the profit and loss from the rental of the properties will have to be declared by both spouses. So you can decide that you're doing 50-50. But if you are married in community of property, unfortunately, SARS is going to require you to submit that. Let's look at other deductions very quickly. There is a Section 18A donations to approve PBOs. There are some of us who are doing donations to NGOs. If that NGO has got an exempt status, and so just ask them to give you proof of their a Section 18 donation certificate. A lot of them do agree to do that because they've got a PBO status. So you can make a deduction where you are doing you've got an income protection insurance premium. You can actually deduct that because at the end, when SARS pays or when your insurance company pays you that policy, pays for that policy, you are going to be taxed on it. So that is why here you are in a position to do a deduction for it. Where the other deduction is you go to Ntabiseng and ask the hair to give you a tax opinion or to do your tax return, you can deduct those fees. Legal expenses that you incur for you to do your farming operations or your side hustles, as long as it's for income generation, you can actually get those expenses deducted. Let's talk about some of the most important things again that you need to be aware of before the end of the year. So I've spoken a lot about tax stuff. Yeah, just make sure that if you have forgotten, you can always come back to the presentation and look at it. Let's talk about the tax-free savings account. There's a lot of people that are selling tax-free savings account. Banks are actually talking about it. But here, let me give you the advantages in terms of you making sure that you do your full allowable contribution in a year. So this has got nothing to do with your tax submission, but on your tax return, SARS is going to ask you if you have made any contributions to a tax-free savings account, or you'll say yes if you have actually done so. The annual allowance is 36,000 per individual. Yesterday I was talking to some guy who was saying, no, I need this for my family. It has to be a family thing. No, it's per individual. For as long as you have got an ID number, it doesn't matter whether you've got a tax number or not, but that ID number will allow you to have that allowance, because at some point you will end up having to declare if you are a small child. So you can have a tax-free savings account. If we are 5 in a family, you can have 5 of them at 36,000 per annum, per individual. And the lifetime limit for each person, not family, its lifetime limit is 500,000. So this takes you close to 13.88 years, 13 years and about 8 months to actually complete the 500,000. The important thing here is that all growth is tax-free. In the next slide, I'm going to show you an example and you will be in a position to see the benefits. Let me also indicate that there are also those people who are overzealous and they will actually do an extra deposit of some sort. Unfortunately, SARS is going to charge you 40% penalty on that excess deposit. So this is a very good tax planning and, let's say, retirement planning or legacy planning tool. I had a session some time ago where we were talking about tax-free savings account. And the key message that I want to bring here now is that the tax-free savings account protects long-term growth from SARS. And unfortunately, SARS cannot fix this retrospectively, or you cannot fix this retrospectively. They only look at it prospectively. So make use of that. The important date again, make sure that you top up. If you have not reached your 36,000, make sure you top up before the 28th of February for you to get that benefit in future. Here I've got an example of some calculations for those that think that this probably is not, there's no benefit in doing the tax-free savings account. Imagine you contributing 3,000 on a monthly basis, and that grows at an annual return of 8%. By the way, I've seen some tax-free savings account in the last year that grew by 20% because of the market rally. I have seen that personally, where somebody has actually gained close to 20% in their portfolio. So here I use the conservative amount where you're looking at 8% and you invest that for 13 years. The 500,000 that you would have invested is going to grow by 896,000. It's going to grow to 896,000. This is provided you do a 3,000 Rand contribution on a monthly basis. Obviously, the returns or the calculation will be different if you are doing 1,000. Obviously, when you do 1,000, it's going to take you more than the 13 years. It's going to take you many, many years. So if you might want to maximize on the 3,000 monthly. If you are not in a position to do 3,000 monthly, you can look at doing a yearly deposit of 36,000. When you look at 36,000 paid once a year at that rate of 8%, your growth is going to be about 871,000. So there's a difference of about 25,000. There's a difference of about 25,000 between when you do your monthly deposits and where you do a deposit once a year. So remember, the important thing is no tax on the additional growth, not even capital gains tax. There is no tax. Therefore, the tax on the taxable investment, the tax reduces the final value. So make sure that you take advantage of the tax-free savings account as one of your tax planning tools. Let's talk about the Section 12B investment allowance. This is something that is overlooked by a lot of people. I'm telling you, a lot of people. This is not only for business persons, for business people or businesses. This applies to every individual. There is a lot of companies that are providing Section 12B investment opportunities where the value that you have invested in that year is fully deductible. I'm going to talk about the example here. If you didn't know about Section 12B investment allowances, make sure that you familiarize yourself with that, especially the youngsters that are starting to invest. This is one of the best investment vehicles as well, where you actually utilize Section 12B. So let's say that you are a business owner and you install a solar system that costs you 500,000. And you bring and you switch it on, you bring it into use before the 28th of February. So in terms of SARS, in terms of Section 12B of the Income Tax Act, SARS is going to allow you a deduction of 100% of that expense. Hear me clearly here. You invest 100,000 into a company that does Section 12B or into a solar investment. The full cost of that, SARS is going to allow you 100% deduction. Imagine if you are at a taxpayer with a marginal rate, or your tax rate is about 45%. That means that you have actually gained close to 45,000 rands from that 100,000 investment alone. And that is a huge tax saving. And that tax saving, what you do, if you did not maximize on your tax-free savings account, you say you go and put it into your tax-free savings account. If you have not maximized on your retirement annuity, you put it into your retirement annuity. So this is also one of the most powerful year-end planning tools available, but it only works if you put the asset into use before the 28th of February. So let me talk about the provisional taxpayers. If you are a provisional taxpayer and you're sitting here today, you must ensure that you have got accurate income estimates, because SARS charges penalties if you underestimate your income or your taxable income. SARS is going to hit you with a penalty for that. On top of that, he's going to charge you interest as well. So those 1,000 or the 500s that you see where SARS says you did not submit your tax return, there's more to it. So you must make sure that your estimates are correct. Remember, earlier on I spoke about the dates. If you are a provisional taxpayer, there are 3 dates that are important for you. The first date is the 28th of February. Sorry, the first date is the 31st of August, where you're doing an estimate for the full year, and then you are going to have that, and you pay whatever that you need to pay in August. And then you have got a second estimate that you do on the 28th of February, and you must also make sure that you pay in if there is an estimate that you are going to pay tax. And the last, there is a third one, where if you realize that you have underestimated your provisional tax payment, you can do the third estimate on the 31st of September, on the 30th of September. Remember, provisional taxpayers, our assessments are not due in July. Our assessments are only due in January. So those 3 dates allows you to fix whatever mess that you have, so that by the time you submit your income tax return in January, you have actually cleared those under estimations and things that you have actually ignored. So provisional tax paying allows you to plan your cash flows, because you are in a position to reduce your tax liability 3 times in a year. So make sure that you use that as a provisional taxpayer. So I'm about to conclude on my presentation. Let me just look at some of the common mistakes that we see when people come to our offices for tax advice. People claiming private expenses as deductions, especially when it comes to the usage of the car. The other one is missing logbooks, not maintaining a logbook for your business and travel, for your business travel, or not having the correct IT3 certificates. So that is also one of the issues. And ignoring foreign income and assets. Now SARS requires that if you have got assets outside of South Africa, you need to declare those assets. If you haven't yet done your balance sheet, make sure that you prepare your balance sheet, because now when you submit it to SARS, SARS is going to require that. The other common mistake is late submissions and poor estimates of your expenses. So make sure that you do that, you avoid those mistakes. Lastly, in terms of your tax year and checklist, hence we are doing this today on the 28th of January. So it means you have got 30 days to actually go, a full month, to go and consult either your accountant or consult a tax practitioner who can actually assist you in preparing you for tax at the end of the year. Make sure that you are aware of how your IRP5 is going to look like. So you can even prepare a spreadsheet of your payslip for the last 11 months, so that you can determine where your income is going to be. Your medical expenses, medical aids do supply you with statements. Make sure that you know that. IT3 certificates for your bond, there's a lot of things for your investments. Just make sure that you get that in place. Update your logbook. If you are with a tracking company, I'm not advocating for them. They don't pay me money, but I'm finding that their service is quite useful, where they provide you with a logbook. You can actually sit on your phone instead of scrolling social media. You can sit on your phone and start updating the business trips versus the private trips. And by the time you go and print your logbook, you can actually get all of that information from a tracking company. And keep your records, expense records. Remember, I said that if you are the unfortunate one and SARS requires to do an audit on your tax submission, they are going to need an invoice and a proof of payment. Make sure that you do that. So I've spoken about reviewing your contributions. Now it's a good time for you to do a contribution. And I know that there are some employers, when you go to them, let's say you've got enough income, you can go to your HR department and ask them to do an over deduction for you for February month, so that you can actually take advantage of the retirement annuity contribution, unless if you want to do an additional one, or your pension contribution. The important thing, again, if you don't know how to do it, please consult a registered tax practitioner. Tax practitioners, for those that do not know, tax practitioners are registered. There are some bogus tax people, if I can say that, but just be aware that if you are going to require services of a tax practitioner, make sure that the tax practitioner is registered with SARS or any other accounting body or it's a lawyer or something like that. But there is a PR number that you need to have. So we have come to the end of our session. So I just need to indicate that MMCP Wealth, who is part of MMCP Advisors, is a licensed financial services provider. You can see our number there. And we are a registered tax practitioner, which is PR 0001797. And it is important that you consult with the right person. And just as a disclaimer, what you did at SARS 4 years ago might not apply this year. Earlier on, I indicated that there are changes in legislation. SARS, on a regular basis, they update their legislation, they update e-filing and that. So what you did last year might not apply this year. There might be some enhancements. So, important thing, tax legislation changes. Interpretation might differ from person to person. The examples that I've given you in terms of the returns, they are also an illustration only, and they might differ depending on your circumstances. So hence it is important that when you do any investments, you consult an investment advisor, and professional advice is always recommended. If you would like to have a personal year-end tax readiness review, my team is available to actually make sure that we can assist you with that. You can go to our website or any of our social media pages. You will get information on how to contact us, or you can contact us on info@mmcpadvisors.co.za. And let me take this opportunity to thank you again for joining our session this afternoon. And for business owners, be on the lookout for the same session which we are going to be providing. Unfortunately, it's going to be again on the 28th of February, and I know it's a very big day, so we might end up having it on the 27th or on the 26th of February. If you are a business owner, please make sure, or you're running a side hustle, please make sure that you are joining us for the next session where we will be talking about taxes and your business. Thank you again for joining us, and make sure that you follow us on YouTube, MMCP Advisors. On TikTok, we are there, and Instagram. Thank you very much for your support. Cheers.